Let's get across the market open now. We are joined by Zach Rios from Banyan Tree Investment Management. Zach, welcome back. A big day ahead with the RBA decision. Let's first look at, obviously, there's developments overnight with renewed hostilities in the Middle East, and that has sent oil prices soaring.
Yeah, good morning, Andrew. We honestly, to be honest, we were expecting, and I don't think we were the only one around the world with this thought, but we expected hostilities to sort of kick off again, and they are. Look, hopefully it's a bit of a skirmish and a bit of to and froing, but I think the tensions in the Middle East and the expectations of individual parties in this conflict are still very far and apart. And so we think you're better to side on err on the side of caution rather than become very bullish at this stage. And the movement in oil price is just a very good example. And I think I heard you, the bond yields, the spike in 30-year bond yields, they're obviously the 5% for the 30 and 4.5% for the 10-year in the US. They're critical sort of sentimental levels that I think the markets will be watching. And so equities could have a bit of a wobble.
Well, take a look at, certainly when we look at global growth expected to come off.
Yeah.
But at the same time, inflation rising, it does raise the prospect of stagflation, of course. In fact, we've got a couple of charts. Let's just go to it. The first one being there just with that global economic growth outlook.
Yeah, and it's basically just, the charts it's a neat way of summarising that the world economic outlook is basically continues to see growth expectation moderate and inflation expectations or forecasts continue to rise. So stagflationary issue is not just an Australia issue, it's a worldwide phenomena or a concern. And so we're going to continue to sort of test this narrative. The worst scenario would be that we actually start to realize it in a material way. And I think one of the reasons the market is still continuing to sort of put this aside is, I think this chart's a very interesting one. It basically shows you inflation has not hit core inflation yet. So therefore, most people are still sort of taking the view, well, it's not in core, it's only headline, so we can kind of ignore it for the time being. But at some point, that headline inflation and the persistence of it will start to flow into core. And I guess that's why the RBA is likely to raise rates. It's already gone twice. I think I may have heard a story that in the US, they're still looking to cut rates. I don't think that's going to happen. So this chart is worth to watch. If it starts to move into core, you're going to see some more resetting of asset prices.
Now, Zach, of course, we've already had a number of companies come out with profit warnings, essentially. Is it your expectation that is going to continue, and what are we likely to see with earnings estimates?
Yeah, look, we are cautious going into, obviously there's still a bit of period before the August results for Australia, but look, the Australian earnings expectation, so the orange line is FY27, but put aside FY27 for a while, but the blue line's FY26. Earnings expectations have started to roll over in Australia. And at only a week or two ago, Andrew, according to Bloomberg estimates, ASX 200 was expected to grow. The earnings were expected to grow by around 18%. Now, that's a bunch of expectations in there. I would say there's some stale expectations in there as well. But there are other brokers that are certainly at between 13-14%. So give and take, there was double-digit earnings expectations for the ASX 200 for FY26, and they have now started to roll over. And even 2027 has started to roll over materially. So, we've still got some time before we get the full earnings visibility, but you're starting to see companies, whether in different parts of the P&L or whether it's top line impact, you're likely to see that worm continue to come down. Hasn't shown up in the US earnings so far. They are backward looking. That is a first quarter result. So, I think that is something you're likely to see continue to sort of come down. And if the RBA again raises rates, they would have, I believe, fully negated last year's.
Yeah, we had 3 cuts, so looking for the third hike in a row, perhaps with more to come. Odds are that they will hike again today. As I mentioned, there is the possibility, some forecasting, that will be another 1 or 2 to come this year. Given how high then rates will be sitting at, are you avoiding those interest rate sensitive stocks?
Yeah, look, in general, I think you've got to pick and choose. I think we're all interest rate sensitive. Obviously, some a little bit more, the REITs in general, and obviously some of the bond proxies. But, even consumer related stocks. But I think within that, what you've also got to understand is the individual nuances of some stocks, and also where maybe expectations have already been reset. And so I think the REIT sector has already started to bake in some of the earnings expectations or potential impact from future rate rises. And so, Mirvac is one that has had a recent slide in the share price. And I think it's first and foremost, the company just recently provided its quarterly update. They have reaffirmed their full year DPS guidance. They've reaffirmed their full year operating earnings guidance. And I think where the stock is trading right now, it normally, or it's certainly in the past has found, even in the 2020 has found a floor. These are hard assets. I think this is the other thing investors need to get their head around. Eventually, the shift from intangible to hard assets is still happening, and stocks like infrastructure and some of the property plays, I think, are going to get a bid once we sort of let this rate rises wash through. So I'm really liking Mirvac.
All right, so you're on that halo trade, the hard assets, low obsolescence.
Absolutely, and that's been going on since September last year. And if you just chart the Nasdaq versus some of the more hard assets, that's been in train since October last year. So I don't think that's going to change.
Just from a portfolio position at the moment, what's your level of cash?
Elevated. So we are, from a multi-asset perspective, we are underweight risk assets. We were underweight risk assets going into this year because we expected Iran to kick off. Within our direct equity strategies, we are above 5% cash levels. In all of them, for our small cap strategy, we're above 10%. So, it's hurting us a little bit when we did go into cash, but liquidity is at a premium right now, so we're happy to play that.